Good morning, it's Jeff Christian. It's about 10:16 here in the morning in New York on the 19th of October. I wanted to talk today about central bank gold transactions in 2021. Specifically, I had made a comment in a video a couple weeks ago about how central banks had actually pulled back from buying as aggressively as they had been in earlier in the year. Central bank activity has actually gotten very interesting this year. I'll run through some of the things, but we basically saw a period of about 3 months where central banks really stepped up to the plate and were buying a lot of gold, and they were buying, it was new central banks or central banks that weren't particularly significant buyers in the recent past that were doing the buying. And since that time, that has ended. So I want to run through central bank transactions a little bit, and then at the end of the presentation, I hope to remember to talk about where we are with the markets, and also a little bit about silver. Central banks have been net buyers since 2008. You can see from this chart, back in the 50s into the early 60s, central banks were net buyers or accumulators of gold. And that was because we were under the gold dollar monetary system, and central banks were settling their international accounts in gold. Also, very importantly, a lot of central banks had drawn down their gold reserves during World War II and the Great Depression, and they were rebuilding that. So you saw gold being used to settle international accounts, and central banks were adding gold. That ended around 1967, 1968. You can see those big spikes down where central banks actually seemed to be selling gold. And what was happening was that we were on this dollar gold system. The gold price was fixed at $35 an ounce. The dollar was under a lot of downward pressure. You had about 20 years of constant devaluations of different currencies under the dollar gold system. And Lyndon Johnson suspended gold convertibility for private institutions. You know, central banks and monetary authorities could still come to the U.S. Treasury and say, I have U.S. dollars, give me gold, $35 an ounce exchange rate. But private corporations and individuals from overseas could not do that, starting in, I believe, March or April of 1968. And you saw this massive drawdown of U.S. Treasury stocks in 67, and you continued to see it at an even more accelerated rate in the first quarter of the year. So that's why it was actually April. Lyndon Johnson closed that window because there was this massive drain, 45 million ounces in 67. And in the first three and a half months, more than 20 million ounces of U.S. Treasury gold going to private entities. And they said, look, let's annualize 20 million ounces across 4 quarters. And we've got 80 million ounces as opposed to 45 million ounces. We don't want to keep giving away our gold at $35 an ounce. So we're closing the private sector gold window, and pow. You then had a period of time which was sort of a transformation away from a gold standard to floating exchange rates. Initially dirty floats, as they were called at the time, and then pure floats, just letting the market decide what individual currencies were worth minute to minute, hour to hour, day by day. During that time, you did see a period in the late 1970s where the IMF restituted some of the gold that had been given to it by members for payment of their membership. They returned some of that gold, about 25 million ounces, if I remember correctly, and then they sold about 25 million ounces to whoever wanted it. And the U.S. Treasury also sold about 50 million ounces over about a 3-year period. So you started to see this reorganization of the way monetary and central banks looked at gold. By the early 1980s, central banks were saying, okay, it's been 10 years, 12 years since we were on a gold standard. We're moving away from a gold standard. We don't think we're ever going to go back. So a lot of central banks that had built up gold reserves either from 50 to 65 or prior to that, started to lease and sell their gold. And you saw a little bit of that through the 80s. It accelerated after 1989. And the reason it accelerated after 1989 was that central banks were saying, okay, now it's 19 years since we were on a gold standard, but more importantly, you had a movement toward the European central banking system. You had the Maastricht Accord in 1989 that said January 1st, 1999, you will have a euro, and all of the European governments and central banks that are opting into the European monetary system and adopting the euro instead of their domestic currencies will come under the guise of the European Central Bank. And if they want to make major changes to their monetary reserves, which would include buying or selling gold, they need to go to the ECB and sort of coordinate that and get it approved by the ECB before they do it. So all the central banks that were going into the euro knew that by January 1st, 1999, if they wanted to sell some gold, they should sell it. And you saw this acceleration of gold sales by central banks, primarily in Europe. The Australians and the Japanese and the Canadians sold some too. But primarily what you saw were governments that were opting into the euro system. Their central banks were selling gold. Switzerland was not opting into the system. They said, we do want to sell some of our gold, but being good gentlemen, we're going to wait until 1999 to start our sales program so that we don't, get, so that the people who do want to sell before January 1st, 1999 are not competing with us to selling their gold. And then the Bank of England opted out of the euro after the currency crisis of late 1992. And they also said, in a gentlemanly way, we're going to wait until 1999. I won't bore you with more details about it, but it was a very interesting time. You saw those central banks that had a lot of gold that wanted to sell some of their gold. In many cases, they were saying, I want to sell a third or a half of our gold and stoke up on currencies to help us defend our currencies, because that's what you want monetary reserves for in a crisis. You saw that continue up until about 2007. By 2007, most of the central banks that wanted to sell some of their gold had sold the gold that they wanted to sell, and you saw a sharp decrease in gross sales by central banks. At the same time, you had a number of other central banks, Russia, China, Thailand, South Korea, who were not big trading partners during the dollar gold standard or earlier, and had not accumulated a lot of gold, but had accumulated an enormous amount of dollars because they had become bigger trading partners on a global basis in the years after 1971. You saw those central banks saying, look, we've got 90% of our monetary reserves in dollars. It's time for us to start diversifying our monetary reserves into euros and yen and Swiss franc and pound sterling. And, in some cases, they would say, we want our monetary reserves to sort of be in the same proportion as our trading balances with individual countries. And we want to buy a little bit of gold. And most of them have bought a little bit of gold. Chinese, the People's Bank of China actually bought a lot of gold, but if you look at it as a percentage of its total reserves, which are about $3.3 trillion right now, it's a little bit of gold. Russia actually bought a lot of gold, and because it doesn't have a lot of foreign currency reserves, its purchases of gold have been much larger. And you've seen since 2008 a period of net purchases by central banks, which reflect the fact that those central banks that wanted to sell gold earlier in the 80s and 90s and aughties have sold what they wanted to sell, and they're sort of content with what they have. And other central banks are buying gold because they want to diversify their portfolio. It's very strange. It's the same impulse, but the empirical result is the difference. You have some central banks that want to diversify their portfolios, which means getting away from having so much of their assets in gold. The Swiss National Bank had about 98% of its monetary reserves in gold. So they sold half of it, and they actually passed a policy that said, we don't ever want to have more than 50% of our monetary reserves in gold. So if the gold price rises and the currencies actually decline, i.e. the dollar declines, we'll sell more gold. And you have that same impulse. I want to diversify my reserves in other countries. which means we're going to buy gold. We're going to get rid of dollars. So gold-rich central banks were diversifying into dollars, and dollar-rich central banks were diversifying into gold. It's the same impulse. We want to diversify our monetary reserves, but a different physical result because of where they were at the time of that beginning. And that's where we've been ever since. Now, let's focus in on what's going on here this year. Just over the last few years, before I get into that, central banks, we look at gold, we say total supply, mine production and scrap, fabrication demand, use of gold in fabricated products where the nature of the gold ceases to be bullion or bullion coins and starts to be something like jewelry or decorative objects or pens or electronics or shields for annealing paint on metal, things like that. Fabricated demand, and then stock demand. And stock demand is investment demand and it's central bank demand. And we look at the stock demand, and what we see is that central banks are much more price sensitive than private sector investors. Private sector investors like to buy high, and when the price falls, they buy less gold. Central banks like to buy low and sell high. So they will actually be much more price sensitive. And when they see investors bidding the price up, they'll pull back. And when they see investors less interested in gold and the price comes down, they'll buy more. And you can see, just looking since 2008, when the gold price was rising 2008 to 2012, central banks weren't buying all that much gold, about 10 million ounces a year on average. When the gold price started falling 2013, 14, 15, they actually were buying 20, 25 million ounces for a couple of years. When the price flattened out, they kind of walked away. When the price started rising in 2000, they pulled back. This year, what we've seen is a change in the elasticity of gold. Now, I'm taking this from 2020 through this year, and you can see 2020, prices rising, and you saw that central banks were not particularly aggressive buyers, 500,000 ounces in some years, net 7 months, net sales in several months last year. Starting this year, they started the year by being net sellers in January. They bought a little bit in February, and then March, April, May, there was this big ramp up. And the gold line, the golden line here is the gold price. You could see, the price was high, they weren't buying a lot. The price fell and they bought a lot. So that's price elasticity 101. But the interesting thing is where they were buying. When they picked up their their purchases on a net basis in March, following into April and May, the price of gold had fallen down, had gotten up to $2,000 on an intraday basis. But the price had fallen into that 1740, 1840 range. And you saw central banks saying, hey, these are good prices in our view for long-term acquisitions. And central banks don't necessarily sell a lot of gold. I mean, it's a monetary reserve, it's a stable base. They like to buy it and they like to hold it for a long period of time. An institutional investor might say, I'm interested in buying gold or any other asset with a 3 to 5 year time horizon. But a central bank doesn't have a time horizon. They say, we like gold. And what we saw in that period, March, April, May, was central banks basically saying, we think prices around $1,800 are good from a long-term perspective. That's a very bullish message about what they think the future gold price is. Now, as the gold price rose, they bought less into April and May. And then as the gold price started falling, they pulled back. And you can see, June, July, August, this only goes through August. You can see larger declines to relative very low levels, back to where we were in the 2020s. And it doesn't make sense. Okay, the price is falling. So wouldn't you be buying more as an elastic, price elastic buyer? And the answer is not necessarily. If we bought 1740, 1800, 1840, and the price has fallen, maybe we were actually wrong, or we were maybe too early in our bullishness about the long-term outlook for gold. So let's wait and see how low the gold price goes before we resume purchases. I think that's one of the major factors that you're seeing here, and it's there. Now, we excluded transactions from the IMF, Turkey, and China. And I'm not sure why we excluded China, because I don't think there have been many transactions there. Turkey, I'll talk about a little bit later, because that's a very special case, radically different attitudes at the central bank. The Central Bank of the Republic of Turkey has radically different attitudes and practices vis-a-vis gold. Oh, I've got the wrong title here. I'm sorry about that. But tellingly, if you look at gross long and short purchases and sales of central banks over the last 18 months, 20 months, what you see, again, you see those big purchases in March, April, May, and then you see very little being sold at those prices, higher prices. And then as the price started to come down, they actually started to sell a little bit more. And then they got away from that. So who's buying and who's selling? I said earlier, one of the interesting things we saw in that period, April, May, and really continuing, was that you had central banks that weren't necessarily previous buyers buying gold. Thailand has been buying gold for a couple of years, but it was the largest purchaser of gold in the first 8 months of this year. And they bought about 2.9 million ounces. They have some domestic political issues, and they have a lot of dollars. Actually the trade, people talk about the backup of ships in Long Beach and LA ports. Trade between Asia and the United States is up something like 27% year over year right now, I'm sorry, from 2019 to now, it's up about 27%. It's up 27% since pre-pandemic levels. So there's an enormous amount of things being shipped from Asia to the United States and to Europe. And that's one of the reasons why you have these ships backed up. There are other reasons too, but we won't go into that. But Thailand has a lot of dollars coming in. And they have domestic political issues. They've been buying a lot more gold. Hungary has issues domestically, political issues, but it also has a variety of disputes with the EU and might actually part company with the EU in some ways. So they've been buying gold, about 2 million ounces, and Brazil has been buying gold, about 2 million ounces. These are central banks that have not been seen as major buyers 2008 into 2020, but they're there now. And you can see then, Uzbekistan, they've been steady buyers all along. That gold tends to be domestic production. If you mine gold in Uzbekistan, you sell it to the central bank. And central bank says, this is how much the government is going to export and sell, and this is how much we're adding to the central bank. And they have decided this year to add so far about 1.4 million ounces to their monetary reserves from domestic production. India has been a sporadic buyer, but they've added 1 million ounces. And in Australia, which sold most of its gold in the 80s and 90s, actually bought about 500,000 ounces back, adding to diversifying their portfolio. And then a number of other countries, smaller amounts, but still significant, Mongolia, Cambodia, Serbia, Colombia, Czech Republic, and Egypt. So you're seeing more central banks, and you're seeing different central banks being buyers, and you're seeing a couple of them being significantly high volume buyers. The flip side, the columns on the right, are the central banks that have been selling over the course of the year. And here, Turkey, you can see 1.7 million ounce decline. Now I'll talk about that in a second. The Philippines, about 1 million ounces. They have some domestic issues that they wanted to raise some dollars. Kyrgyz Republic, Germany, may have been coins. Russia actually sold about 100,000 ounces earlier, and that's interesting. There's a little bit of a misstep this week in the gold market. Russia was a big buyer really from 2009 or so into early 2020. I think they bought about 900,000 ounces in the first quarter of 2020. They have been actively buying. They have sanctions against them from the US. They have rising political and economic and trade tensions between Russia and the US, Russia and the EU. And so they have been diversifying their portfolio. Most of their foreign exchange earnings come in as dollars still, despite the fact that they reached ostensible deals where they'll price their exports in other currencies. The settlement is still in dollars. So they're constantly getting rid of dollars, buying gold, and they buy the gold primarily from domestic production. Now, when the oil price, because that's their largest export, oil and gas prices are their largest exports, and they represent an enormous part of their foreign exchange earnings, and they also represent taxation on the oil and gas industry, represents an enormous portion of the government's annual revenue. So when oil and gas prices fell in April of last year, the Central Bank of Russia stopped buying gold. It has not really been buying gold ever since then. Actually, it has not been buying gold since then. It went from 7.9 million ounces to about 7.8 million ounces, and it's been holding steady there. They did sell about 100,000 ounces earlier this year. Oil and gas prices got very low. They stayed low. They moved even lower, and now they're rising sharply. So Russia may reappear as a buyer of gold again soon because oil prices are starting to rise. They still have a variety of issues that they're dealing with, but that's beside the point. They could be there. Now, this week, the central bank issued its monthly statement, and it said that its gold and foreign exchange reserves have risen to record levels. And some people read that and said, oh, their gold reserves have risen to record levels. But if you look at it, the gold reserves are unchanged. It's the foreign exchange reserves that have risen to record levels, and that's because the oil price has risen sharply over the last several months. So they have a lot of dollars coming back into their coffers, and that again may trigger future purchases by the Russian central bank, but it hasn't actually yet. So in September, their foreign exchange reserves rose to record levels, but their gold reserves were unchanged. That's about it. You know, others relatively small sales. Turkey, as I said, is a special situation for central banks. And the Central Bank of the Republic of Turkey has really done what we think is a remarkable job in mobilizing gold reserves. They have gold reserves. You can see from the blue part, that's the central bank's gold reserves. And they were unchanged really from the early 1990s until about 2017. They have started buying, and they've added actually aggressively to their monetary reserves. Back in 2011, starting in October of 2011, they created this thing called the reserve option mechanism, which allowed commercial banks that were registered with the central banks to meet some of their reserve requirements with gold, dollars, and euros. And that orange portion primarily represents that amount of the central, it shows up on the central bank's balance sheet, because when a commercial bank is part of the central bank network, and it has to post reserves, those reserves show up on the central bank's balance sheet, like a deposit at a bank. That's because that's what it is. And so you see actually this gold rising sharply, and a lot of that is actually gold that is ostensibly owned by commercial banks and their clients, and is being used to meet the reserve requirements with the central bank. In addition to that, the Turkish Central Bank has a gold bond deal program for Turkish citizens, whereby a Turkish citizen says, I have gold, but I need cash. My alternative is to sell it in the market, and when I'm out of my financial straits and I want to buy the gold back, the gold price may have changed and it may be much higher. But I can take that gold, I can use it to buy a Turkish central bank gold bond, and I'll pay an interest rate on that. And when I want to get my gold back, I redeem the bond. And yes, I lose that interest rate, which is, I think, about 2%. But I get the gold back at basically the same price I let go of it when I bought the bond. So it's a price protected way of monetizing your gold. The central bank also has a program for leasing gold, where you can bring gold, including gold and jewelry, to a commercial bank, a nationally chartered commercial bank, and you can lease the gold back to the central bank. Well, not back to the central bank. You can lease the gold to the central bank and get cash. Now, in 2020, we saw the Turkish central bank adding to its gold reserves. That's this little rise here, and people got very bullish. But it wasn't that the central bank was buying gold in the market for addition to its monetary reserves. This was the function of gold coming into the central bank and onto its balance sheet through the gold bond and the gold leasing program. This year, this was a reflection of the economic lockdown, along with sanctions against Turkey, Turkish political unrest, Turkish problems on the Syrian border, Turkish problems with the Kurdistans, Turkish problems with Europe, you name it. There were a lot of reasons why people wanted and needed cash last year in Turkey. They used their gold to get cash. Things are better this year to some extent. So they're actually redeeming those bonds and unwinding those leases, and that gold is coming out of the Turkish central bank. So when we talk about Turkey reducing its monetary reserves by 1.7 million ounces through August, it's not that they're selling monetary reserves or that the central bank has said we don't want to have as much monetary reserves. What it really is it's a function of this private sector internal Turkish program. That's all I have about central banks. I did want to talk a little bit of a diversion. I spoke last month at the Silver Symposium in Coeur d'Alene, and the Stock Pulse, which put that Silver Symposium together, has now posted at least one of the programs. It was a 54-minute discussion with David Morgan and me about silver, and this guy who calls himself the economic ninja moderated it. And he started off with questions that he had, but then he opened it up to the floor. And the entire 54 minutes is very interesting. And I think that investors would find it very useful and very informative. And, you know, David and I have known each other for many decades, and there's a mutual respect there. It was a very good presentation. I think the 54 minutes are worth it for anybody who's serious about investing in silver. About halfway through it, the economic ninja opened it up for questions. And a member asked me a question about why are refiners buying 1,000-ounce bars and then selling them? And the answer is because they can make money doing it. But, you know, it seems that there's somebody who went out and said, well, you know, this is highly unusual. They don't do this, but it's happening. And, you know, they say, oh, they're buying bars off the COMEX. No, they're buying bars that are stored in COMEX registered inventories. Some of those bars are actually registered and with the COMEX clearinghouse, but they're not buying silver off the COMEX. I saw a video this morning of a guy who was talking about, I'm trying to take delivery off of the COMEX, and I call the COMEX and they say, well, we don't deliver silver. You know, your broker, you know, you have to talk to your broker. You got the warrant because you took delivery of a futures contract. You have the warrant, you have the depository receipt. You can work with your broker to give delivery of it. So, you know, that's the level of expertise that these guys have, that they don't even realize that you don't go to the COMEX and buy silver from the COMEX. You buy it from a participant in the COMEX. But regardless of that, refiners always do that. I mean, it's an arbitrage opportunity. I'm in the business of refining and selling silver and gold. And when the arbitrage allows me to make extra money, that I can buy 1,000-ounce silver bars from other people and sell them at a higher rate, and that arbitrage is greater than my cost of doing this business, it's found money. So I'll do that. And it's not just refiners that do that. Traders do that too. That's why they're called traders. So somebody asked me about this because some pundit has said, oh, this is unprecedented that refiners buy 1,000-ounce bars from other people and then sell them at a profit. And it's not unprecedented, it's very common. So I was explaining this to the person who asked me the question. And I was explaining to him, that it's not unusual. And I was interrupted. Now there's a video clip from the interrupter. I was the YouTuber. The guy who was very self-promotional. And he interrupted it so that he could videotape it and post it. And he posted this little video clip of a few thousand seconds, and it's gruesomely taken out of context. But you can now, in the 54-minute video, see what leads up to it and what comes afterwards. David Morgan, I was sort of ticked off and I let my ire show. I sometimes do. I had said earlier in the symposium, I don't know what it means to suffer fools lightly. And I didn't suffer that fool lightly. David Morgan came to my defense and very eloquently pointed out that the guy was simply wrong. And that's worth watching in and of itself. And then the economic ninja said, hey, Jeff, since this is something that a lot of people probably don't know about, why don't you talk about this subject? Which I did. And the subject was somebody who fraudulently put himself forth as saying that he was an ex-banker, that he worked at J. Aaron, that he knew all the conspiracies and such. And it turns out that no, he was a car leasing agent, and he never really worked at a bank, at least not as a bullion trader. So David explained it. I explained it. It's worth saying. It's drives home something that a lot of investors have learned this year, that real research and real understanding often isn't accurately portrayed in video clips by people who are trying to sell something other than real research. Anyway, it's worth seeing. There's the link. In terms of the market outlook, we've seen precious metals prices move up today. The dollar is off. Interest rates are actually relatively flat. Oil prices are high. We're not quite sure what's going on here. It's probably pretty much just that some technical price points were hit, which brought in a lot of purchases and drove the prices up. Silver is about $24 before I started this video, and gold was around $17.80. Our expectation is that the precious metals prices still have some risks of lower prices, not as big of risks as we saw in August, but we still think that there is some downside potential there. And so from a very short-term perspective with our trade recommendations on gold and silver, we're telling people that, they might want to sell silver and look to buy back at 23, and they might want to, sell gold and look to buy back at 1750. Longer term, we still think that we're in a base building period and that we'll see modestly higher prices next year and much higher prices at some point in the next 5 years. So that's sort of our view on the markets right now. That's all I have for today. We'll come back on Friday and find a new topic of interest. Thank you.